Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're dived into the Tidal ETF Trust semi-annual shareholder report. Get ready because with a portfolio turnover rate that might give you whiplash, it's either financial genius or someone's playing musical chairs with stocks. This report covers the period from August of last year to January of this year. It's like a mid-year checkup to see how these exchange-traded funds or ETFs are doing. There are two funds in this report: the Aslan Global Stock Selection DM Sub ETF and the Aslan North American Nearshoring Stock Selection ETF. We'll call them the Global Fund and the Nearshoring Fund for short. These are basically collections of stocks you can buy into, like a pre-made investment basket. First, let's get a quick overview of what this report includes. It's got the fund's investments, how they're doing financially, and some important details you should know as an investor. Think of it as the ETF's report card, giving shareholders an understanding of the fund's performance and activities. Let's talk about costs. For the Global Fund, if you had a hypothetical $10,000 investment, the cost for the past 6 months would be $40. This is an annualized figure, meaning that it's based on an estimated cost of $40, but is expected to happen over the course of the whole year. This means the expense ratio, or how much it costs to run the fund, is 0.75%. So for every $110 you invest 75%. So for every $100 you invest 75%. So for every $100 you invest, $750 goes to expenses. As of January, the global fund size was about $27.6 million. It had 51 holdings, meaning it was invested in 51 different companies. But hold on to your hats because the portfolio turnover was a whopping 277%. This means the fund basically bought and sold its entire portfolio almost 3 times during those 6 months. That's a lot of trading, which can lead to high costs. Looking at where the global fund puts its money, the biggest chunk, 22%, is in industrial companies. Consumer cyclical, which are businesses that tend to do well when the economy is good and people are spending, makes up about 19.9%. Then consumer non-cyclical, companies that sell things people need no matter what the economy is doing, is at 17.9%. As for specific investments, the top holdings include companies like Sanma Holdings Corp and Skyward Specialty Insurance Group Inc. These each make up about 2.1% of the fund's total net assets. So the fund isn't putting all its eggs in one basket. Now let's switch gears and talk about the Nearshoring Fund. This fund is focused on companies that could benefit from the trend of bringing manufacturing and other business activities closer to home in North America. For the Nearshoring Fund, the cost on that hypothetical $10,000 investment were $37 for the past 6 months, also an annualized figure. So like the Global Fund, it also has an expense ratio of 0.75%. This fund is smaller than the Global Fund with about $10-20 million in assets. It also has fewer holdings, only 30 different companies. Its portfolio turnover is lower at 82%, but still significant. This means it's not trading as rapidly as the Global Fund. Looking at the Nearshoring Fund's sector breakdown, the big focus is on financials, which make up a whopping 62.9% of the fund. Industrials come in second at 30.7%. This fund is much more concentrated than the Global Fund. Its top holdings include Corp Inmobiliaria Vesta Saber de CV and Prologis Property Mexico SA de CV, each comprising 5.6% of the fund. So this fund is heavily invested in a smaller number of companies. Now let's look at how these funds are performing. We're going to focus on the big picture, not every little number. The Global Fund had a net investment income of about $51,000, but the big gains came from investments with a net realized and unrealized gain of about $2.5 million. This means that overall, the Global Fund made money from its investments during this period. In contrast, the Nearshoring Fund had a net investment income of about $77,000, which is actually better than the Global Fund. However, it saw a net realized and unrealized loss of about $410,000. This means that overall, the Nearshoring Fund lost money from its investments during this period. Remember that insane 2077% turnover for Global? That's how they made so much. They bet and they won. It's risky, but it worked out. Let's check out the financial highlights per share. For the Global Fund, the net asset value, or NIV, started at $22.02 and ended at $24.02. The Nearshoring Fund's M ended at $21.79 and ended at $21.17 and ended at at 21.79 cents and ended at 21.79. So it ended at 21.79 cents and ended at 21.49 cents. It actually had a negative total return of 261%. So global is up a bunch and nearshoring is down a bit. Now, let's dive into some of the risks these funds face. Keep in mind that it is just some of the risks, but not all of them. For the nearshoring fund, being so focused on a few sectors like financials and transportation can be risky. If those sectors do poorly, the fund will likely suffer. Another big risk is geographic concentration, since the nearshoring fund focuses on the United States, Canada, and Mexico. If something bad happens in those countries, the fund could take a hit. The report notes in a small disclaimer then, since it focuses its investments only in those three countries, it may be more volatile than a more geographically diversified fund. Both funds face high portfolio turnover risk. The global fund, especially with that wild 277% turnover rate, this means lots of trading, which can increase costs and potentially create some tax headaches for investors. There are obviously pros and cons to such big turnover rates. The global fund may be more at risk due to its diversity, because adverse governmental actions as well as a potential failure to qualify for tax-free pass-through of income. The note also states that these are pooled investment vehicles with their own fees and expenses, and that the funds will indirectly bear a proportionate share of those fees and expenses. So what's the overall takeaway here? It seems that global took big risks and got big wins. It may have been luck, but it doesn't take away that numbers are what they are. On the other hand, it seems that nearshoring played it a bit safer with its diversification, and thus it got a slightly negative return. However, it can be said that both had positive net income, but the losses came from investments. Also, it is good to note that the fund may be more volatile due to its investments. Overall, the Tidal ETF Trust seems to be doing what it says on the tin. Of course, past performance is never a guarantee of future success, and these funds come with their own set of risks. Be sure to consider those risks, your own risk tolerance, and your investment goals before making any decisions. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and don't forget to subscribe for more corporate deep dives. We will see you next time.